Since December 2015, the Federal Reserve committed to increasing interest rates. They were very hesitant as to not spook the markets, which had been fully supported by 0% interest for so many years. Then they promised to, quote, normalize their balance sheets and finally began doing so in late 2017. They allowed an extremely small amount to mature on a regular basis, and the markets didn't like it. Throughout 2018, we witnessed the first bad year since the financial crisis for nearly all assets. Today, there are rumors floating around that the Fed is now considering to halt their quantitative tightening policy and leave interest rates where they are. It is now undeniably clear that the Fed is supporting the market entirely, and without their quantitative easing program, the markets will crash. You came here for the truth, so let me unveil that for you. Today we are going to talk about the Fed. I think it's important to focus on the Federal Reserve's actions, everything that they say, their forward guidance, and all of the topics surrounding that. Today we're going to look at the information which has come up suggesting that perhaps the Federal Reserve is not going to continue to print any more money. They're going to actually stop this quantitative tightening program and hold everything where it is. We are looking at a historically easy monetary policy that has been incredibly accommodative to the markets. However, we do not see the analysts, the CEOs, the bankers, and everybody else acknowledging that fact, except when markets go down and they point the finger at their balance sheet, at their tightening policy, and say, stop doing what you're doing. You're causing a problem. But it wasn't the case on the way up. No, just on the way down. Interesting how that works. So let's get into the details today. I really broke it down into specific points of data, so stay tuned until the end when I show all that information. First, we're going to look at these two articles. The Fed may be moving closer to ending its rally-killing balance sheet reduction. Fed officials have been discussing when to curtail the reduction in the bonds it is holding on its balance sheet. So we're going to go through all the details today, but let's just cover the basic points for now. Recent indications from central bank leaders indicate that the end of the program is getting nearer. Markets have attributed the tightening of financial conditions in part to the roll-off in proceeds from what had been a $4.5 trillion balance sheet. Further in the article, they're talking about the situation and how it has really come to this point. Federal Reserve officials are nearing a decision on when to end the reduction of the bonds it is holding on its balance sheet, a key consideration for investors watching how far the central bank will go in tightening monetary policy. They're already looking at this. However, we are being told that everything fundamentally is totally fine. There's no recession in sight. So why wouldn't you want this tightening monetary policy? Why wouldn't you want reality to be restored? Yet, this is what we have to deal with. They suggest that what the Federal Reserve has done isn't pushing up the equities. However, they simultaneously suggest that tightening the monetary policy causes problems. You must acknowledge both sides of the equation unless you want to fool yourself. The Fed began the balance sheet roll-off in October 2017 after it had reached more than $4.5 trillion. Wall Street has worried that the operation is adding to market pressure stemming from a series of interest rate hikes that began in 2015. So there's more details in here. Basically, this CNBC article was taking info from this Wall Street Journal article. Fed officials wait earlier than expected end to the bond portfolio runoff. It's important to follow what they're saying here, what they expect to happen. I want to touch on a few points from here, particularly dealing with Powell. Now, I did a few videos about the Fed, about Powell previously that outlined what he said. Basically, in this conference, he suggested that it would be a long time, an automated process to allowing the balance sheet to run off. Over time, they would do so. It's automatic. People should just be aware of it, but there's nothing to worry about. And then they started to become a little, quote, dovish, as they love to use that word, because we won't continue to do so if the markets start to come down. Of course, they had said that in every previous year, but this is what we get in the media. Suddenly, they're bringing that up. Anyway, what we're looking looking at today is the fact that maybe the markets require more quantitative easing in order to be stimulated higher. Not to naturally go higher, because the markets can't do that. They require that stimulation, the stimulus, whether it's a TARP bailout, whether it's quantitative easing. We'll see. However, this is what we are getting today. Mr. Powell said this month that he doesn't think the Fed's portfolio changes are a major culprit in recent volatility, but that the central bank would change its drawdown if officials came to a different conclusion. Basically what I said, suddenly if everything changes in their mind, then they would stop printing, they would stop increasing interest rates, hold everything where it is. Apparently, there's a battle going on within the central bank deciding, should we approve more stimulus? Should we not approve more stimulus? The funny thing is that they're suggesting that their stimulus is directed towards the economy, and it's not. It's towards the bankers and the elite. And in the last paragraph here, just some interesting information for those who aren't aware about this. Reserves are the funds that banks keep on deposit with the Fed. When the Fed expanded its portfolio of bond holdings during and after the financial crisis, it expanded the amount of reserves in the financial system, pumping banks with money as it bought bonds. The banks in turn kept the new money on deposit with the central bank. Things are starting to change, interest rates are changing, liquidity is drying up, and suddenly this policy isn't working anymore. So we encountered 2018, and a lot of people, particularly those holding equities, did not like that at all. So what I have right here is a bunch of the data that I believe is extremely important to know. Let's get through it as quick as I can. The current size of the balance sheet is over $4 trillion. Many argue that the amount they have printed isn't much when compared to the overall quantity of investments, therefore it's not a big deal. However, with just $400 billion rolled off of the balance sheet, it's very clear that the markets are extremely fearful. If there wasn't a problem, you would let it go much more quickly. If the Federal Reserve wasn't supporting the markets, you would not do it at $36 billion a month. You would do so at a much higher rate, $100 billion a month. Why not get rid of this over a period of a year, maybe 2 years? It's been years now. We're looking at the end of 2017. We're going into this period of time of increasing interest rates at the slowest possible pace because you're scared. It is absolutely clear that what has now been understood is, in fact, that central banks control the markets entirely. Their liquidity is essential for the positive function of markets today. Without their monetary easing on a consistent and increasing basis, the market will fall. Interest rates have been near record low and extremely accommodative, yet the market depends on this to continue forever. Just this extremely small increase so far has been incredibly painful for investments, notably through 2018. Look at the first bad year since the financial crisis happens to coincide entirely with quantitative tightening, and it was such a small amount. $1 trillion worth of quantitative tightening spooked the markets to the point where 90% of assets were in the red. Interest rates don't have much room to go down in the next recession. Typically, you would have a lot to play with interest rates to ease the markets. This time, they may have to go into the negative, and that is when you know you have a destructive policy. People will be extremely burdened by it, as well as when they have to increase interest rates after that moment. In order to keep interest low, it doesn't come without consequences. The central bank must engage in open market operations. This is not just a simple setting on a computer. They must actively print money to do this. And if you're interested in open market operations, I have a video in my free e-course, which you can check out on my channel. Overall, objective has always been for the central banks to not only buy up the assets, but to be given permission to do so by the public. These foreign profit-seeking institutions will gather more support and print money out of thin air, buy the assets of your country, and have more and more leverage over what happens to you. That's what people don't understand. All they care is that their equities are doing just fine. They don't care that the central banks are printing money and buying up everything in sight. All they care about is themselves. Big mistake, because it will come around to haunt you. If you care about sovereignty, if you care about your country, and if you care about your freedom, you should oppose all actions and even the existence of the central banks. Unfortunately, most people do not understand the function of the central banks. All they care about is what they're holding in their hands, and this is very, very short-sighted. If you found this video informative, please give me a thumbs up. You can support this channel. You can support me simply by clicking the like button. That's all you need to do. Thank you for that. I really do appreciate it. If you want the financial education that you were not taught in school, well then, these two books have everything that you need. You can get the foundation, the history, the asset classes, everything you need to know are in these two books. So check them out at the link in the description. If you want the financial education in audiobook format, you can get that at themoneygps.com.